Have you ever stopped to think what finance would look like if there were no banks? I mean, we all know the traditional system, right? But right now, there's this whole parallel digital universe being built on the blockchain. So, okay, let's dive into this tale of two financial worlds: traditional finance versus decentralized finance. Here's what we're going to cover in this explainer. First, we'll lay out the basic differences. Then, we'll get into the most critical question: who's actually holding your money? After that, we'll see how DeFi is trying to build finance without any banks. And of course, we have to talk about the brand new risks that come with it. And finally, we'll ask, what happens next? All right, let's set the stage. You've got this system that's been running things for centuries on one side, and on the other, you have this totally radical new idea that's trying to flip the whole script. This is it. This is the big question that powers the entire DeFi movement. Just imagine for a second a world where you can borrow, lend, and trade directly with anyone else, with no bank or brokerage firm taking a piece of the action or telling you what the rules are. That right there is the dream of DeFi. So here's the difference in a nutshell. TradFi, or traditional finance, is all about trust in institutions, banks, stock exchanges, you name it. They're the gatekeepers. DeFi, on the other hand, wants to get rid of the gatekeepers and replace them with code. It uses these things called smart contracts on a blockchain to basically put financial services on autopilot. And that idea of getting rid of the middleman brings us to what is, honestly, the most important difference between these two financial worlds. It all boils down to one simple but powerful word: custody. So what do we even mean by custody? It's not just about where your money is physically or digitally stored. It's about who has the final say, who has the power to actually move your money. This idea is absolutely central to everything we're about to talk about. And this is where the two models just go in completely opposite directions. In TradFi, you delegate custody. You give your money to a bank. And a lot of people don't realize this, but that money isn't just sitting in a box with your name on it. It's technically a loan to the bank. You have a claim to get it back, and you're protected by things like FDIC insurance, but the bank is the custodian. In DeFi, it's all about self-custody. Your assets are in your digital wallet, and only you have the keys. You have total, absolute control. You are, quite literally, your own bank. So you're probably thinking, if there are no banks, how does anything actually work? How do you trade? How do you lend? Well, this is where DeFi gets super interesting because it rebuilds all those core services from scratch with a few really clever pieces of technology. The first piece of the puzzle is the smart contract. The easiest way to think about it is like a super smart vending machine. You put in a specific coin, and it's programmed to automatically spit out a specific soda. No cashier, no negotiation. It's just code that follows the rules no matter what. That's a smart contract. Okay, next up, liquidity pools. Now, instead of a traditional exchange that matches one buyer with one seller, DeFi uses these giant crowdsourced pools of tokens locked inside a smart contract. Anyone can toss their crypto into the pool to help make trading possible. And why would they do that? Well, in return, they get a cut of all the trading fees. It's like everyone gets to be the house. And that brings us to the real engine of DeFi trading, the automated market maker, or AMM. This is the algorithm, the brain, really, that uses those liquidity pools to figure out the price of an asset at any given moment. So when you make a trade, you're not trading with another person, you're trading directly with the pool, and the AMM's math formula sets the price. Now, when you put all these pieces together, smart contracts, liquidity pools, AMMs, you get this incredibly competitive environment. And this quote from Nat Eliason just nails it. Crypto is a giant game of incentive design with billions of dollars on the line. It's all about creating automated systems that encourage people to put their money to work. And that leads to some pretty wild stuff. A perfect example is something called the Curve Wars. So Curve is this huge decentralized exchange, and it has its own token, CRV. If you own and lock up your CRV tokens, you get to vote on which liquidity pools get the most rewards. Well, other crypto projects quickly figured out it was way cheaper to just bribe CRV holders for their votes instead of buying the tokens themselves. This set off this insane battle between different projects to control the flow of rewards on Curve. The winners could direct billions of dollars wherever they wanted. It's just this raw, fascinating example of how these code-based incentive games play out in the real world. So, being your own bank, it sounds pretty empowering, doesn't it? And it is. But, as they say, with great power comes great responsibility. And in this case, it also comes with a whole new world of risks that you just don't see in traditional finance.
Just take a look at these numbers. I mean, they're staggering. We are talking billions, with a B, of dollars just drained from these protocols through hacks and exploits. Look at those huge spikes in stolen money. And now look at those tiny little red bars at the bottom. That's how much gets recovered. It's almost nothing. Unlike with a bank, there's no fraud department to call, no FDIC insurance. When the money's gone, it is gone for good.
And it's not just about getting hacked. There are these other really unique financial risks, like something called impermanent loss. It's a bit of a weird concept, I know, but basically, if you put two tokens into a liquidity pool and their prices start to move apart, you can actually end up with less money than if you had just held onto the tokens yourself. The fees you earn have to be more than that potential loss, or you're actually losing money by trying to help. At the end of the day, all of this risk lands right on your shoulders, the user. A tiny bug in the code of a smart contract could mean everything in it gets stolen. You could accidentally click on a bad link, approve a malicious transaction, and a scammer could drain your entire wallet in seconds. You are the only line of defense. There's just no safety net. Okay, so we have all this amazing innovation on one side and all this terrifying risk on the other. Where is this all going? Is DeFi going to take over the world? Or are these two financial systems going to figure out a way to work together? Let's talk about the future. DeFi still has some huge mountains to climb. For one, regulation. Regulators are scratching their heads because their entire system is based on watching the middlemen, and DeFi's whole point is to get rid of them. Then there's speed. Blockchains like Ethereum are just too slow right now for global finance. And let's be real, using most of this stuff is still way, way too complicated for the average person. But even with all those roadblocks, the wall between these two worlds is already starting to crumble. Take a look at this. We're already seeing real-world assets, like stocks and companies like Apple and Coinbase, getting turned into tokens and traded on blockchains. This is the very beginning of a hybrid system, where you get the speed and transparency of DeFi mixed with the established assets of TradFi. Which brings us back to the ultimate question. What's the endgame here? Are we watching the rise of a complete replacement for the financial system we've known our whole lives? One that's more open, faster, maybe more fair? Or are we just seeing the start of a merger where the best ideas from DeFi get pulled into the traditional system to create some new kind of hybrid beast? Honestly, nobody knows for sure, but the fight for the future of finance is happening as we speak.